We have just a few minutes left in the trading day. That means it's time for the big picture. Let's welcome in our guest from Charles Schwab today, Cooper Howard, the director and fixed income strategist for the Schwab Center for Financial Research. Cooper, thanks for being with us again today.
Of course. Well, thanks for having me on.
Absolutely. Now, we got a lot of data out today, durable goods, the GDP revision, jobless claims. What stood out for you most?
You know, what stood out to me most is we got the unemployment claims. So I think that that's a weekly indicator that we usually get, obviously. Not necessarily the initial claims, but the continuing claims continue to tick higher. And that's been the highest that has been in some time. So I think that that's just evidence, or a little bit more evidence, that the labor market's further softening. So it wouldn't be too big of a surprise if we start to see the labor market soften going forward. And I think that ties into Fed policy. And ultimately, the Fed's going to try to get ahead of that and not let it soften too much. So we did get a lot of data this morning, but I also think another interesting piece is that if you look at 10-year treasuries, there wasn't too much of a market reaction to that. And what you highlighted in one of your last segments, I think, is the perfect statement for what's happening right now. And there's just a lot of wait and see. So the 10-year treasury, kind of that part of the yield curve, is in wait and see mode, and wait and see what happens with tariffs, what happens with the economy, and what happens with Fed policy.
Absolutely. I mean, that's just the time we live in. No matter what we're talking about, that message almost consistently stands. You know, you mentioned the tariffs expiring. You know, we're fast approaching that date. But also, do you think that we saw the bond markets go down just a hair on that note from President Trump saying that he may select the new head of the Fed early, which could then potentially influence some of the rate cuts for the rest of the year?
Yeah, so I think that that's trying to kind of what the market's trying to navigate going forward. I don't necessarily think that it will influence rate cuts going forward. I think that the way that the Federal Reserve is set up, being that it is a committee, it's not one individual that's going to dictate where interest rates are going to go or if they cut or not. So our expectation, though, is that they are going to cut at the September meeting, or excuse me, it looks like they are going to cut at the September meeting. Right now, if you look at the market expectations, they're very high for that. They're about 90%, which I think is relatively appropriate. July looks a little bit early in my view. It just seems that we don't have enough data between now and the July time period for that to ultimately dictate that a rate cut should come into play. And if you listen to Chairman Powell's most recent comments, he's really kind of pushed back against a July rate cut.
Yeah, and he has, but we've certainly seen in this past week or so, you know, some of the other Fed presidents coming out and saying that they support that July rate cut. With PCE coming out tomorrow, if the numbers decline or don't go in favor of what we're expecting, do you think that we'll see an uptick in the revision percentage numbers of the possibility of a July rate cut?
You know, I would not be surprised if we see a revision in the probability of a rate cut in July, but ultimately, will it happen? I don't think that it will happen. Now, there is a lot of time period between now and then, so anything really can happen. I'll caveat it with that. But if you look at what the market's expecting, it's only about a 20% probability of a rate cut. So yes, if we do get not good inflation numbers tomorrow, that could probably shift things around, but it needs to shift around quite a bit before the market is expecting that rate cut to come down the pipeline.
And we've been talking a lot about bond markets, but are there areas of the market specifically that you see as areas of opportunity? Yeah,
so one of the areas of opportunity that we still believe exists is the municipal bond market. If you just look at yields there, the average yield for a broad index of munis is about 4%. And that's an index that's usually exempt from federal income taxes, the interest that it pays. So that's pretty attractive if you were to adjust it for a fully taxable bond. Couple that with the fact that most of the munis in that index are very highly rated, either AAA rated or AA rated. And we think that that market does make sense for a lot of investors who are in higher tax brackets looking for kind of a more conservative income option in their portfolios.
So if you want to invest in a muni, does the type of account that you own matter?
You know, that's a great question and a great point, because yes, it very much matters. You want to make sure that if you are investing in a muni that pays interest income that's exempt from federal income taxes, that you're investing in a fully taxable account. That would be something like a brokerage account, for example. Now, there are municipal bonds that pay interest that's subject to federal income taxes. They represent a very small portion of the muni market, less than 10%. If you're investing in something like an IRA, maybe it could make sense to add those into an IRA. But at the bottom line, end of the day, usually if you're investing in munis, you want to invest in a fully taxable account like a brokerage account. So that's a great clarifying point.
And another question about munis specifically, they tend to be more independent of the performance of the broader economy, right? Because of by nature.
Yeah, that is correct. So a lot of the revenue sources that municipal bonds receive that are backing the bonds themselves tend to lag overall economic activity, or they're not very correlated with economic activity. So for example, there are water and sewer utility districts. They issue bonds. Now, even if we go into a recession, it's highly likely that we're still going to pay our water and our sewer bills. If you look at states, the number one revenue source for states is income taxes. Those are usually based off of prior year's income taxes. So that gives, if we go into a recession or a slowdown in the economy, gives states a lot of runway in terms of planning purposes to make adjustments to their balance sheets and their spending going forward.
Well, Cooper, thank you so much for all those tips on munis. Again, that's Cooper Howard, the director and fixed income strategist for the Schwab Center for Financial Research.